So the first thing I'd say is that this definitely took the banks by surprise. Definitely took their heads of comms by surprise. None of them knew about this call or these sets of calls until the Treasury Secretary started tweeting about it. And it's fair to say the bank CEOs themselves were also taken by surprise.
Taken by surprise that the call came, or that they put out an announcement saying these calls were happening?
The call was happening at all yesterday. I think once it happened, perhaps they knew by the end of the call they were going to make an announcement. Haven't got much colour directly from the CEOs, apart from on one of them speaking to someone close to that CEO about what the discussion was on. And they said that CEO cited 4 reasons as to the reason the market has pulled back: China, the shutdown, Italy and Brexit, and trade wars. And that's the reason market's down. On the topic of liquidity, did say that this was the general message. Markets are functioning fine, but there are pockets of illiquidity. Now, on the topic of illiquidity, which is clearly the central point of this whole statement from Secretary Mnuchin, 2 big differences from the financial crisis. The first, banks' own liquidity is not in question. We've got a chart of total assets since pre-crisis, risen dramatically. They've been forced to boost their capital levels, as we know. And liquid assets, as a portion of that, has also risen. It used to be about 10% of total assets. It's now closer to 20, about 17, 18%. There's no question that there's going to be a Lehman Brothers that can't meet its daily liquidity needs to the other banks. On the flip side, the market itself is a bit more illiquid because of automatic trading and the like. And on that topic, separate CEO I spoke to 2 months ago addressed what effect that's had on the market. David Solomon Sock, please, guys.
Maybe or maybe
growth
not.
of passive product, index product, ETF, the growth of systematic trading, and also, machines more involved in what we do. All those things are untested over any duration of time with severe stress. Now, when we see a little bit of stress, you can see reactions that might lead you to believe that there's a risk that with more significant stress, that could play a bigger role. But I wouldn't predict that, but it's certainly something we watch. And there's no question, when you look at last week, some of the selling is the result of programmatic selling, because as volatility goes up, some of these algorithms force people to sell.
I'd say overall, banks, CEOs, no question that their own liquidity is absolutely fine. But clearly, when you see big moves in the market, it defines the point that we're not as liquid as we were a few months ago.
No, but I'm glad you made that point, because the topic of liquidity takes us immediately back to the financial crisis. But when we're talking about the markets themselves, it's a completely separate issue.
Yeah, well, listen, I think from my take on reading the statement, yes, Secretary Mnuchin says the banks are fine meeting the needs they have to fellow banks and consumers, which is slightly worrying that he mentioned that.
Right.
But I feel like this call was more made because the markets have been volatile, and the main people that deliver trades every day are banks.
It's almost like you should have called TD Ameritrade or something.
Right. What I was going to say, interestingly,
as brokers.
At least from my understanding of it, and I made a handful of calls and spoke to some people who I think spoke to him over the weekend, I don't think he made calls to State Street or BlackRock or any. But you're talking about where the liquidity,
ETF providers,
where the real liquidity issue is, if there is going to be one. And I don't want to suggest there's a problem. That's where you'd want to try to understand that issue, don't you think?
Yeah, well, and look, money supply growth has massively fallen as well. It's not actually declining yet, but that's a big factor for the market as well, and that's a sort of slightly different factor. But the kind of, oh gosh, why is the Treasury Secretary calling the bank CEOs about liquidity? It is not because they've all been drawn into a room like they were, Andrew, as you reported on better than anybody else a decade ago, because we're worried one of them hasn't got enough liquidity itself.
Well, let me ask you, at the top you said there were 4 reasons that they cited, China being the first. Is that the trade war with China, or is that the slowing economic situation in China?
Didn't get more specifics on it, but it's generic big macro factors here, which we're all aware of. We talk about every single day. The shutdown, interestingly, was cited as one of them. If you wanted a short-term
government shutdown here,
reason to sort of shout at the government for it. But these are factors we're all very well aware of, and the market has pulled back in a more pronounced fashion, in a 3-month view or in a daily view, partly because there's more automatic trading. I don't think that's a new factor. It's just bizarre that the Treasury Secretary felt it necessary to have a call with bank CEOs and issue a statement about it.